video of our multi-video seller series, we shall look not only at cash versus finance buyers, but also at the different types of financing available for buyers at the time of making this video. Financing that a seller of ours may encounter in their buyer's offer. Here are 12 points to note when considering the means by which a buyer is going to be bringing the funds required to close on a home purchase.
Number 1. Cash buyers. We often hear the term cash is king, but what is it about a cash buyer that makes contracting to a cash buyer seem so appealing even if this buyer comes in low on account of being cash? The greatest appeal of the cash buyer is their high certainty of being able to close on the home purchase with just an inspection contingency in place once the home goes under contract. Once the home inspection has taken place and the cash buyer has indicated that he is content to move towards closing, we can consider the transaction at that point to be pretty much a guaranteed close. If the cash buyer should fail to close after the inspection contingency has expired, then the cash buyer normally would lose his or her escrow deposit.
Number 2. Financed buyers. Financed buyers, like cash buyers, also have an inspection contingency in place at the outset, but they also have an added contingency, and that is one of them being able to obtain financing. The financing contingency generally remains in force till just a few days prior to the closing date. The period during which the financing contingency remains in place is called the loan commitment period, and the length of this period is stated on the sale and purchase contract. At the end of this period, if the buyer has still not been able to obtain a loan commitment from his or her lender, the buyer just needs to convey this fact to the seller and is entitled to have his or her escrow deposit refunded in full, making it very difficult for a seller to be certain of a closing until close to the end of the transaction. If the lender for the buyer feels that the buyer is able to obtain financing, but the lender just needs some additional time to make this happen, then the buyer and seller may agree to extend both the loan commitment period and the closing date.
Number 3. Reasons for loan denial. The reasons for loan denial are many. It goes without saying that if a buyer loses his or her source of income, then the lender will be unable to approve the buyer for a loan. Additionally, the buyer may inadvertently do something to alter his or her debt to income, or DTI, ratio by taking on an additional debt commitment or by taking a cut in income. The latter could well be out of the buyer's control. In the case of a buyer who is barely able to qualify with regards to his or her DTI ratio, something as unavoidable as an increase in interest rates could throw off that very sensitive ratio balance and cause the buyer to no longer be able to qualify for a loan. Sometimes a past bad debt situation, such as a past home foreclosure, short sale, or bankruptcy, could raise its ugly head and prevent loan approval. Additionally, the buyer may again inadvertently do something to alter his or her credit score, and if the score was already borderline, that small shift in credit score could lead to a loan denial. Past debt history aside, with loan approval being so dependent on both credit score and DTI ratio, the buyer has to tread carefully during the loan commitment period.
Number 4. Appraisal. Another reason why the loan may be denied is because the appraisal or valuation ordered by the buyer's lender may come in lower than the purchase price on the contract. If the seller will not agree to reducing the purchase price on the contract to the appraisal value, and the buyer does not have the additional funds to bring to closing to bridge the gap between the purchase price and the appraisal value, then the contract may have to be terminated and the escrow deposit refunded to the buyer. The lender will not lend money on more than the appraised value. In a seller's market, when inventory is in short supply, many buyers will be competing against one another. The finance buyer may therefore agree at the time of going under contract to pay a certain amount over the appraisal value should the appraisal value come in lower than the purchase price on the contract. Alternatively, the buyer may waive the appraisal contingency entirely and agree to pay the full purchase price on the contract no matter what value is brought in by the appraisal.
Having looked at the reasons why a loan may be denied, let us look now at the variety of loans available to buyers which our sellers may encounter when presented with an offer.
Number 1. Conventional loans. A conventional loan is frequently used by buyers who are buying the home as an investment or as a second home to use for vacations. The minimum down payment for an investment loan at the time of making this video is 20%, and for a second home loan it is 10%. Primary home buyers may also use a conventional loan if their credit score and DTI ratio is sufficient to qualify for this type of loan, and then the down payment may be as low as 3%. A conventional loan, as well as being less picky about the condition of the home, has the added bonus of having no private mortgage insurance or PMI for the buyer to pay monthly, so long as the down payment is at least 20%. Even in cases where the initial down payment is less than 20%, the PMI may be removed during the lifetime of the loan if the buyer, during his or her ownership, can demonstrate that the equity in the home has now reached at least 20%. This can be due to either repayment of a portion of the loan or rising property prices, or a combination of the two.
Number 2. FHA and VA Loans. FHA and VA or veteran loans are government loans. In general, it is easier for a buyer to qualify for this type of loan rather than a conventional loan, as the credit score requirement is lower and the allowable debt-to-income ratio is higher. These loans are only available to buyers purchasing the home as their primary residence, and in the case of a VA loan, the buyer also needs to be active or past military personnel. Buyers with these loan types are not usually as desirable to a seller, as the special FHA and VA appraisers have more stringent criteria for passing the home for a loan and can insist that, for example, any wood rot in the home is repaired by the seller before the buyer's loan will be approved. We have already mentioned in a previous video that homes in poor condition are best advertised as not being available for FHA or VA buyers. The minimum down payment for an FHA loan is 3.5%, and a buyer buying with a VA loan may obtain 100% financing and so have no down payment to make whatsoever. One of the biggest drawbacks of an FHA loan is that the mortgage insurance premium, or MIP, remains for the life of the loan and cannot be removed. However, VA loans have a MIP factored into the financed amount.
Number 3. USDA Loans. A USDA loan is a home loan guaranteed by the United States Department of Agriculture. In order to qualify for this type of loan, a buyer needs to make sure the loan lies in a USDA-approved location, which typically is of a more rural nature. Homes in a more urban setting will not qualify. Like FHA and VA loans, this loan may only be used to purchase a primary residence. 3 of the benefits to a buyer of using this type of loan is that there is a no down payment option, 100% financing, the MIP is factored into the loan amount, and the program has more flexible credit and qualifying guidelines like the 2 government loans mentioned previously.
Number 4. Non-Conforming Loans. A non-conforming loan is a loan that fails to meet bank criteria for funding. The reasons for this include the loan amount being higher than the conforming loan limit, lack of sufficient credit, or a debt-to-income ratio that would not allow for one of the loans already mentioned. Non-conforming loans generally require a higher down payment and carry a higher interest rate. In the main, this type of loan is only used as a last resort by a buyer who is not able to qualify for one of the loans mentioned already.
Number 5. Equity lines of credit. Occasionally, a buyer may prefer to take out an equity line of credit, pulling out money from an existing home that the buyer already owns, which has built up equity over the years. This is usually done because the interest rates on the equity line may be lower than on a direct home purchase loan. If that is the case, then the transaction will in effect be a cash closing, as the buyer will not be taking out any financing on the home they are purchasing, unless of course the amount of the equity line is not sufficient and the buyer still needs to take out a small loan on the purchased home.
Number 6. Foreign national loans. Foreign national loans, as the name suggests, are loans specifically designed for buyers who are not permanent resident card or green card holders. The down payment amounts required for these loans are generally much higher, being around 35% of the purchase price, and the interest rates are also higher.
Number 7. Reverse mortgages. Reverse mortgages allow home buyers of 62 years of age or older to eliminate paying a mortgage on their home, so they only need to pay the taxes and insurance. Generally, the down payment on this type of loan is over 50% of the property value. A reverse mortgage doesn't require the buyer to make any monthly payments. Instead, the mortgage company pays the homeowner monthly payments. The entire loan balance is due when the homeowner dies, moves in with family or into a care facility, or sells the property.
Number 8. Seller financing. On rare occasions when the buyer is unable to obtain financing by any other means, a seller may agree to hold a mortgage on the home. For the seller's protection, the seller will usually ask for a considerable down payment. In a case like this, the closing company will generally draft a mortgage note to be signed by the buyer at closing, spelling out the terms of the seller's financing.
Thanks for watching, and be sure to check out the rest of the videos in this seller series.